Hello, and welcome back to the QuantScore Financial Show, your go-to source for cutting-edge market analysis and data-driven investing insights. Whether you're a seasoned trader, a curious investor, or just someone who wants to understand the numbers behind the headlines, you're in the right place. Here, we break down the market using cold, hard data. No hype, no speculation, just the facts and figures that matter most. Our team dives deep into the numbers, analyzing trends and patterns that most people overlook. Remember, this video is not financial advice. Our goal is to educate and empower you by sharing a transparent look at the numbers and strategies that drive the market. Always do your own research and consult a professional before making investment decisions. Our mission is to pull back the curtain on quantitative trading and share what our algorithmic models reveal. We use advanced analytics and machine learning to uncover insights that can help you make smarter decisions. So, grab your coffee, tea, energy drink, or whatever gets you amped up for numbers and finance, hit that like button to support the channel, and let's jump right into the data-driven world of QuantScore, beginning with our undervalued stocks, then jumping over to our overvalued stocks. Let's get started. First up this week on our undervalued list of stocks, we have Barclays plc, ticker symbol BCS. Barclays is a name synonymous with British banking, a titan of the old world. A financial lion, if you will, surveying its territory with a quiet confidence born of long experience. Powerful, respected, and perhaps often overlooked in today's fast-paced financial markets, sometimes overshadowed by newer, flashier entities but never outshined. With a most recent price of $18.88 and a market cap over $67 billion, Barclays, a cornerstone of commercial banking, providing essential services to businesses and individuals around the world. Barclays currently trades at an amazing price to earnings growth ratio of 1.13, an exceptionally low metric that immediately raises eyebrows and warrants further investigation, and currently the second best ratio on our undervalued list this week. This strongly suggests its earnings power is underappreciated, that the market isn't fully recognizing the value it generates. We believe this is further corroborated with an insanely impressive forward price to earnings of 8.25, coming in second on our list only to our most undervalued stock on the list, based on our quant score. Its steady returns on assets and return on equity are key indicators of financial health and efficiency. Quarterly earnings and revenue growth are strong as well, at 26% and 10% respectively, demonstrating consistent performance throughout the year. Not absolutely explosive, but reliable, a testament to its enduring business model and prudent management, especially if it can be grabbed at a strong undervaluation. The market seems to underestimate this old lion, perhaps focusing too much on short-term trends and overlooking long-term value. Pricing it for a future less impressive than its present, failing to fully appreciate its current strength and future potential. Our models highlight this gap, revealing a discrepancy between the company's intrinsic value and its market valuation. Between perception and reality, a divergence that presents a potential opportunity for astute investors. Barclays stands as a classic undervalued specimen, a textbook case of a company whose true worth is not fully reflected in its stock price. Steady, resilient and overlooked, a financial institution built to withstand the test of time, coming in this week with a quant score of 7. We'll watch to see with keen interest if the market awakens to its presence and whether this sleeping giant will roar once more. Next up on our list, we travel to China's tech heartland to find Baidu, the digital dragon with the ticker symbol BIDU, closing the trading day Friday, priced at $87.81, with a $30 billion market cap. Baidu's price-to-earnings growth ratio of 2.59 is reasonable for the tech industry. But their most highlighted metric for the week is their forward price to earnings of 10.79, average for our undervalued list, but absolutely insane for a major player in the technology sector. The market seems cautious, perhaps due to regulatory risks, but the forward PE is extremely low, signaling anticipated earnings growth. Baidu's returns on assets and equity show efficiency and profitability. And their quarterly earnings growth was a key factor in their quant score this week, with earnings up more than 45% from the previous quarter, and coming in this week with a quant score of 12. The market's risk aversion may be overshadowing Baidu's underlying strength, but our models flag Baidu as undervalued, a coiled dragon with immense potential. Fear may be blinding investors to this opportunity, but we are hoping to open your eyes to this fortuitous investment. Now to the arteries of commerce. United Parcel Service, Inc. Once again, a recent undervalued regular on this channel, even after its consistent rise in stock price since the beginning of April. Better known by their ticker symbol UPS, the tireless worker, closed Friday trading at $99.22 with a $84 billion market cap. UPS's price-to-earnings growth ratio of 1.47 is deeply discounted for a blue-chip dividend stock. The market fears slow growth, but the forward PE suggests strong near-term earnings. UPS boasts high equity efficiency with a return on assets of nearly 36% and robust quarterly earnings growth of 7.4%, despite a slight dip in revenue growth. This is a dividend workhorse built for endurance, not speed, with strong potential growth somehow mixed in. The market may be too focused on short-term earnings, ignoring powerful demand. Our models see UPS as undervalued. Steady, resilient and underappreciated, all culminating into a QuantScore this week of 12. It's a long-haul player whose true strength, in our opinion, is yet to be recognized. Fourth up on our list of undervalued stocks for the market week beginning Monday, July 21st, 2025. Enter the world of semiconductors with Global Foundries, Inc., ticker symbol GFS. The unseen architect in the semiconductor industry, Global Foundries was most recently trading at $40.33, with a market cap $22 billion. GFS is currently trading at a price-to-earnings growth ratio of 1.31, a strikingly low figure for its industry. But the market is pessimistic, pricing it as if its best days are over. We could not disagree more. With their solid PEG ratio, alongside their decent forward price-to-earnings of 25.84, this all suggests anticipated earnings strength, which could suggest their quant score this week of 18. The market may be pricing it for failure, but the data suggests otherwise. Our models flag it as a value opportunity in a critical industry. We'll watch its recovery closely, hopeful our metrics are indeed pointing in the right direction. Only time will tell. And lastly, for our top undervalued stock for the market week beginning Monday, July 21st, 2025, we have a company trying to close back in on that $10 billion valuation mark. Once a symbol of stability and reliable healthcare access, the company now faces significant headwinds. Currently trading at $11.49, Walgreens Boots Alliance Inc., ticker symbol WBA, is our diamond in the rough. A ubiquitous presence in communities across the nation, Walgreens has fallen on hard times, hitting a recent low in September of 2022. Walgreens Boots has been powering back ever since. The company's valuation reflects the market's deep skepticism about its future prospects. But with forward price-to-earnings of 7.62, the best on our undervalued list this week, we simply do not understand the lack of faith in the fiscal responsibility of the company. The market's concerns are deep, reflecting worries about debt, competition and changing consumer behavior. But the forward PE hints at a dramatic earnings recovery, suggesting that analysts believe the company can turn things around. Negative return on equity for the company can help to explain the absolute distaste for the stock from investors. But it is simply one metric showing operational struggles. We do not want to argue against ourselves, but we do want to present the entirety of the facts. Walgreens is currently also ranked in the top 10, specifically at 7, of the worst return on equities for the company list we analyze, which is currently over 800. Yet, revenue growth is a strong 7.2%, demonstrating that the company is still attracting customers and increasing sales volume. But even more impressive was a nearly 200% earnings increase in quarterly earnings growth according to our metrics. Walgreens is a deep value, potentially offering significant upside if it can address its operational challenges and improve profitability. High-risk play. punished by the market, reflecting the uncertainty surrounding its turnaround prospects and the potential for further downside. But not without hope. Its services remain in demand, highlighting the essential role it plays in providing healthcare and pharmaceutical products to communities. And sales are growing, indicating that the company still has a strong customer base and the potential to generate future revenue growth. Our models can't ignore the signals of a potential turnaround, suggesting that there is a possibility the company could recover and return to profitability. It's a creature fighting for survival, with risks. A company grappling with significant challenges and uncertainties, but also opportunity. Reports of its demise may be premature, and a contrarian investment could yield substantial returns if the company can successfully execute its turnaround strategy. Lastly, we have a surprise undervalued honorable mention. This has been a company absolutely loved by math and Maticians since their inception, based entirely on emotion and not metrics. Not to negatively reflect on their financial metrics, but the Rivian Automotive, a young contender in the electric vehicle revolution. Priced at $13.70, market cap $15 billion, Rivian is not yet profitable. No PE, negative PEG, and negative forward PE. It's a high-risk bet on future potential, burning through capital as it scales. Financial health is weak, with negative returns and ongoing losses. Despite financial struggles, demand for its vehicles is surging. Rivian may not have the financials to back up their QuantScore this week, but innovation versus incumbency. And somehow, they managed an undervalued QuantScore of 52 this week, an absurd number with regards to our undervalued stocks, and definitely an outlier amongst our list this week. And the risks are immense, but so is the potential for disruption. It's too precarious for our main undervalued list. Still, its explosive growth makes it worth watching. From a safe distance, the story is just beginning. Now, let's turn our attention to the realm of overvalued companies, at least regards those whose stock prices seem to have detached from the underlying realities of their business. Starting with Axon Enterprise, the enforcer of law enforcement tech. They've carved out a significant niche, providing essential tools and technologies to law enforcement agencies worldwide. Closing Friday's market day, priced at $756.09, a figure that reflects considerable market optimism. Market cap $58 billion, placing it firmly in the large cap category, a testament to its established presence. Its PE seems reasonable at first glance, suggesting a valuation that's not entirely out of sync with its earnings. But the PEG ratio of 62.5 is sky high. This indicates that the price may be overinflated relative to its projected earnings growth. Investors are paying a massive premium, a substantial markup on the underlying value. For future growth, pricing in perfection. The market expects nothing short of exceptional performance from Axon in the years to come. Financial health is mixed, presenting a somewhat ambiguous picture. Strong return on assets, indicating efficient use of its resources, but negative return on equity, which raises concerns about profitability for shareholders. Growth is impressive, no doubt fueled by increasing demand for its products and services. 31% earnings, a substantial increase in profitability, and 38% revenue growth, demonstrating strong top-line expansion. The market is captivated by Axon's rapid expansion, its innovative products, and its dominant position in a growing market. But our models flag it as overvalued, suggesting that the current market price may not be sustainable. The price has run far ahead of fundamentals, creating a potential disconnect between market perception and intrinsic value. The optimism is profound, but the risks are high. Any slowdown in growth or unexpected challenges could trigger a significant correction. Axon is a magnificent creature, a leader in its field with a compelling vision for the future. But flying close to the sun, venturing into territory where valuations are stretched and expectations are extremely high. Any misstep could bring it back to earth, potentially leading to a painful adjustment for investors. Caution is warranted. A thorough analysis and careful consideration of the risks are essential before investing in Axon Enterprise. Second up on our overvalued this week is in the energy and transportation sector, Vistra Energy Corp, ticker symbol VST, which has surged to all-time highs near $193.01, resulting in a $61 billion market capitalization. Its PE of 6.68 seems reasonable, but the PEG ratio of 31.06 signals high expectations. The market is treating Vistra as a high-growth entity, not a steady utility. Financials are strong. High returns on assets and equity, explosive 29% earnings and 41% revenue growth. This performance has driven its stock to new heights. But the market may be extrapolating this growth too far into the future. Utilities are cyclical, and sustaining this pace is unlikely. Our models flag Vistra as overvalued, priced for a perpetual sprint. It's a powerful beast, but the valuation is stretched. Sustainability is the question. Third up on our opinionated overvalued stocks this week, we have a Pluving Corp, ticker symbol APP. The digital peacock, operating in mobile advertising, dazzling with growth. Currently priced at $364.46, translating to a $123 billion market capitalization. Pluvin also has a forward price-to-earnings ratio nearly touching 60, reaching near absurdity. Investors are betting on endless explosive growth. Most of the financials metrics are absolutely spectacular, especially their return on equity, somehow clocking in at nearly 300%. Combine this with a quarterly earnings growth almost breaching 150%. It can be very difficult to expect this company to do anything but grow. Pluvin is expanding rapidly, mesmerizing the market. But the valuation has detached from reasonable expectations. It's priced as if growth can continue forever. A risky assumption in this competitive jungle, especially accompanied alongside an overvalued QuantScore of 43. Our models flag it as incredibly overvalued. A beautiful creature on a precarious peak. The fall could be swift if growth slows, so be fully prepared for the worst-case scenario, if you are not investing your full faith into the company. Fourth up on our opinionated list of overvalued stocks this week we have Robinhood Markets, ticker symbol HOOD. Robinhood is the young challenger in the finance sector, having staged a dramatic comeback after rallying to all-time highs in late February 2025, to then dip, only to go on an absolutely rampage over the past 3 months. Closing the Friday trading day at a price of $109.74, Robinhood is currently valuated just over a $93 billion market capitalization. Combine that with a price-to-earnings growth ratio that is non-existent, investors are betting on a flawless future.
Financials show a real turnaround. Strong returns, explosive 50%, plus growth in earnings and revenue. The narrative has fueled a massive valuation. Our models flag Robinhood as overvalued. Performance is real, but expectations are sky high. Maintaining this pace will be a monumental challenge. The market is betting big, but the risks are significant. The story is far from over.
Palantir Technologies, the all-seeing eye, led by some of the most influential people of our time. Peter Thiel, Alex Karp, Stephen Cohen and Alexander Moore, with continued connections to Founders Fund and Anduril, arguably the leaders of the next generation of venture capital and defense, alongside Trey Steffens and Palmer Luckey, a group not wise to bet against. Palantir currently commands a stock price of $153.52 with an accompanied market capitalization of $363 billion. Its price-to-earnings growth ratio of 4.6 and forward price to earnings of 263.1 are figures not seen since Tesla during COVID and Nvidia for the past 2 years. And even then, Palantir seems to have them been in absurd valuation. Investors are paying for a future of world dominance or world safety, depending on perspective. Other than their price-to-earnings ratios, financials are absolutely solid. Profitable, efficient and growing fast. Earnings and revenue growth are both spectacular. Return on assets and return on equity are both respectable. Palantir's narrative has simply driven its valuation to extreme heights. The price leaves no room for error. Expectations are beyond perfect. Our models flag it as the ultimate story stock. Performance is strong, but valuation is in another reality. The air is thin at this altitude. Caution is essential, so play your cards just right. But once again, math and Maticians cannot stress this enough. Although overvalued in our opinion, be wary investing anywhere other than a Peter Thiel venture. The man has simply been printing money and cultivating relationships beyond any normal person's aptitude for understanding. Our expedition through the digital wilderness, a landscape of numbers, ends for this week for now. We've seen the quiet strength of the undervalued assets and the soaring flight of the overvalued. The market is ever-changing, fortunes shift quickly. This journey was for learning. Quantitative models offer perspective, not predictions. Decisions must be your own, made with care and research. For more weekly analysis, subscribe to Math and Maticians. Thank you so much for watching, and until next time, stay calculating, my friends.